The $45 billion casino wearing a finance costume. In June, two websites you have probably never traded on did $44.8 billion in volume in just 1 month, more than 3 times the monthly handle of every legal sportsbook in America combined. And the people funding it, Sequoia, Andreessen, Horowitz, Morgan Stanley, ARK, aren't calling it gambling. They are calling it exchange infrastructure and paying exchange infrastructure prices. Today, the gap between those two things, because the gap is where the risk is. Prediction markets just eclipsed the entire US legal sports betting industry. Under 5 billion a month last September, 44.8 by June. One caveat, because you will see this quoted without it. Notional volume counts a contract every time it changes hand, including market maker flow. Handle counts money staked, so it isn't apples to apples. But the direction isn't in question. The capital markets are pricing $1 trillion infrastructure play. The capital markets have already made their call. Kalshi was worth 11 billion in December, 22 by May, by late June reportedly seeking capital near 40 billion. On roughly 2.8 billion raised and company stated revenue above $1.5 billion. And Intercontinental Exchange, owner of the New York Stock Exchange, had put over 1.6 billion into the Polymarket. 40 billion is a CME group multiple, not a consumer fintech multiple. It says this is the market plumbing. So let's test that. Strip away the marketing veneer and the revenue engine is a sportsbook. In March, Kalshi did 11.39 billion in volume. 87% of it, 9.9 billion was sports. Not elections, not CPI, not Fed decision, those were the other 13%. Bernstein estimates as much as 90% of Kalshi's revenues comes from sport, so the question belongs on every institutional desk. Strip out the sports betting. What are you paying 20 times the revenue for? The crypto playbook, how a casino mathematically evolves into an exchange. Let me steelman the other side because the bull case is good. Crypto derivatives followed this exact path. Retail speculation builds liquidity. Liquidity attracts quants. Quants attract prime brokers. Spreads compress, the casino becomes infrastructure. On that reading, sports isn't the business, it's the on-ramp. That isn't stupid. But notice what is required. Step 4 has to actually happen. The product now lives alongside retail retirement savings, because this is no longer a separate app you seek out. Robinhood's second quarter event contracts 156 million, up more than a tenfold. Crypto 100 million, down 38%. Equities 129 million. Read that again. For the first time in the company history, prediction markets out-earned that crypto business that defined the company. 20% of the transaction revenue across 28 million funded accounts. Brokers are absorbing the exchange layer entirely. And Robinhood moved to own it. It used the root orders through Kalshi and split the economics. Then it bought MIADX for its CFTC license and launched its own exchange and clearing houses, Rothera. 2.1 billion contracts in a partial first quarter. DraftKings did the same with a railroad. Everybody is racing to own the pipe. The unpriced regulatory arbitrage driving customer acquisition. Here is what the most finance coverage skips. In most states, you must be only 21 to place a sports bet. On a prediction market, you trade the same outcome at 18. Because it's regulated and a derivative, not as gambling. This isn't a technically. It's a consumer acquisition advantage, and it's unpriced. Dr. Timothy Fong at UCLA's report that the patients presenting from prediction markets look clinically identically to traditional gambling patients. The harm is just harder to spot because the product reframes wagering as informed opinion. Market makers are not hedgers, the liquidity wall blocking the bull case. Back to the bull case, this is the most important slide here. You will constantly read the institutions are adopting prediction markets, true, but not how it sounds. Jump Trading and Susquehanna are in. Citadel Securities said it considered it, but they are there as market makers, earning the spread, taking both sides, holding no view. That's the opposite of hedging. Real hedgers can't get it because of one number. Individual contracts carry 10 to 50 million of depth. $100 million hedge moves a typical market 20 to 50%. The insecure cost more than the risk. So, step 4 hasn't happened. The structural binary, federally regulated swaps, or illegal state gaming. Underneath all of it sits an unresolved binary. In April, the Third Circuit became the first federal appeals court to rule these contracts are swaps under the Commodity Exchange Act. Preempting New Jersey's gambling statutes, the CFTC and the DOJ then sued Arizona, Connecticut, and Illinois. But the Massachusetts went the other way. So did the Nevada and the Maryland. 13 states hold active enforcement or live litigation. And traders themselves price a 64% chance the Supreme Court takes this up by in year end. A prediction market pricing the risk to prediction markets. CFTC's hand resets entirely on an unfinalized proposal, and the federal safe harbor everything resets on its not a rule. In June, the CFTC proposed a new framework, broad outcome sports contracts permitted, single play contracts prohibited. But it's a proposed rulemaking. A change in commission composition reverses it. 90% of the revenue sits on top of that. The disruption is already destroying incumbent margins. Meanwhile, the disruption is already in filed earnings. DraftKings posted a $67.6 million net loss, EBITDA down 62%. Management explicitly citing spending on the predictions rollout. Flutter cut guidance by $395 million, fired its FanDuel chief executive. Combined, they will spend $600 million marketing prediction market this year. The trade landscape, proxies for a private market. So, how do you express this? Kalshi and Polymarket are private. Listed proxies are what you have. Robinhood is the purest expression. It owns the exchange and the revenue is already in the numbers. IC is the lowest beta version and arguably the smartest seat because it bought the data feed rather than the casino. DraftKings and the Flutter are the disrupted side, and we will know within a year. The catalyst metrics measuring the survival of the bull case. So, here is what I am watching. 3 things break this. Circuit split forcing the Supreme Court to rule on 19% of the revenue base. Age legislation killing the 18 versus 21 arbitrage, the CFTC proposal failing to finalize. 2 things extended it, the NFL season sustaining a run rate that was flattered by a World Cup and an election cycle. And contract depth clearing that 10 million threshold which brings real hedgers in and makes the thesis right. That's the tell. Watch depth, not volume. Because right now the market is paying for an exchange and the revenue is coming from a sportsbook. Hope you find this video informative and helpful. Thank you. See you soon in the next video.